You work hard for your money. So, when you decide to invest it in the stock market, you want to know where it's actually going. It might seem like buying a stock is just a simple transaction, but there's a whole lot more going on behind the scenes. Understanding the flow of money in the stock market is crucial for making informed investment decisions. It's not just about picking a company with a cool product, it's about understanding the financial mechanics that drive its growth and your returns. Think of it like buying a house. You wouldn't just hand over a suitcase full of cash without knowing exactly what you're getting in return, right? The same goes for stocks. By understanding who gets your money and how it's used, you can make smarter choices about where to put your hard-earned capital. In this essay, we're going to break down the different ways money changes hands in the stock market. We'll start with the initial public offering, then dive into the secondary market, explore buybacks and dividends, and even look at how companies raise money after they've gone public. By the end of this, you'll have a much clearer picture of the financial ecosystem and be better equipped to navigate the exciting world of investing. Buckle up, because we're about to demystify the stock market. Imagine a company like a rocket ship, ready to blast off into the stratosphere. But before it can reach for the stars, it needs fuel. That fuel, my friends, is capital. And one of the primary ways companies raise capital is through an initial public offering, or IPO. An IPO is like a company's grand debutante ball, where it officially introduces itself to the public markets. It's the first time the company sells shares of itself to investors like you and me. Think of it like this. The company is essentially slicing itself up into millions of little pieces, with each piece representing a share of ownership in the business. When you buy shares during an IPO, you're essentially buying a small stake in the company's future success. But where does your money actually go? Well, in an IPO, the money goes directly to the company itself. The company uses these funds for all sorts of things, like expanding operations, investing in research and development, paying off debt, or even making strategic acquisitions. Essentially, the money raised during an IPO provides the company with the financial muscle it needs to grow and thrive. Now let's talk about what happens after a company's IPO, when its stock starts trading on the open market. This is called the secondary market, and it's where the vast majority of stock trading takes place. Here's the key thing to remember about the secondary market. When you buy a stock here, you're not buying it directly from the company anymore. Instead, you're buying it from another investor who's selling their shares. Think of it like buying a used car. You're not buying it directly from the manufacturer, you're buying it from someone who bought it previously. So, in the secondary market, the money you spend on a stock goes to the seller, not the company itself. The company doesn't make any money directly from the buying and selling of its shares in the secondary market. Now you might be wondering, if the company doesn't get my money, why does its stock price go up when people buy it? That's a great question. The stock price goes up because of supply and demand. When more people want to buy a stock than sell it, the price goes up. When more people want to sell than buy, the price goes down. The company benefits from a higher stock price because it gives them more flexibility to raise capital in the future, attract and retain top talent, and even make strategic acquisitions using their stock as currency. Now, let's talk about a fascinating phenomenon in the stock market: stock buybacks. This is when a company decides to buy back its own shares from the open market. You might be thinking, why would a company buy its own stock? Well, there are a few reasons. First, it can be a way to return value to shareholders. When a company buys back its own shares, it reduces the number of shares outstanding, which increases the ownership percentage of remaining shareholders. This can lead to a higher earnings per share, which can boost the stock price. Second, companies might buy back their stock if they believe it's undervalued by the market. If they think their stock is a bargain, they might scoop up some shares at a discount, which can also increase the value for remaining shareholders. So, in a buyback, who gets the money? The answer is the shareholders who choose to sell their shares back to the company. The company then typically cancels those shares, reducing the total number of shares outstanding. Buybacks can be a controversial topic, with some arguing that they artificially inflate stock prices and benefit executives with stock-based compensation more than everyday investors. Others argue that buybacks are a legitimate way for companies to return value to shareholders and optimize their capital structure. Section 5. Dividends. Sharing the profits with shareholders. Let's move on to another way companies can return value to shareholders: dividends. Dividends are essentially cash payments made directly to shareholders, typically on a quarterly basis. Think of them like a thank you gift from the company for holding on to its stock. Companies that pay dividends typically have a history of profitability and a strong track record of generating cash flow. They distribute a portion of their profits to shareholders as a way to share the wealth and reward long-term investors. Not all companies pay dividends. Some companies, especially those in growth industries, prefer to reinvest all of their profits back into the business to fuel further expansion. Others might use their profits for share buybacks or acquisitions. The decision of whether or not to pay dividends and how much to pay is up to the company's board of directors. They consider factors such as the company's financial performance, growth prospects, and overall capital allocation strategy. For investors, dividends can provide a steady stream of income, which can be especially attractive for retirees or those seeking passive income. Dividend payments can also provide a cushion during market downturns, as they offer a return on investment even when stock prices are falling. Section 6. Beyond the IPO, more ways companies raise money. We've covered IPOs, the secondary market, buybacks, and dividends. But what about companies that are already public and need to raise more money? Do they have to go through another IPO? Thankfully, the answer is no. Companies have several options for raising additional capital after their IPO. Three common methods include secondary offerings, private placements, and strategic stock issuances. Each method has its own advantages and disadvantages, and companies choose the approach that best suits their needs and market conditions. Let's take a closer look at each of these fundraising avenues. Section 7. Secondary offerings, tapping the market again. One way companies can raise additional funds after an IPO is through a secondary offering. This is essentially like an IPO, but instead of being the company's first time selling shares to the public, it's the second, third, or even fourth time. In a secondary offering, the company issues new shares of stock which are then sold to investors. The proceeds from the offering go directly to the company, just like in an IPO. However, there's one key difference between an IPO and a secondary offering: the price of the shares. In an IPO, the company and its investment bankers work together to set the initial offering price. But in a secondary offering, the price is typically determined by the market, meaning it's based on the current trading price of the company's existing shares. Secondary offerings can be a great way for companies to raise capital for growth initiatives, acquisitions, or debt repayment. However, they can also dilute the ownership of existing shareholders, as issuing new shares increases the total number of shares outstanding. Section 8. Private placements and strategic stock issuances, alternative funding routes. In addition to secondary offerings, companies can also raise capital through private placements and strategic stock issuances. A private placement is a sale of securities to a select group of private investors, such as institutional investors, hedge funds, or high net worth individuals. Private placements are typically exempt from the registration requirements of public offerings, which can save companies time and money. Strategic stock issuances involve selling shares of stock to a specific strategic partner, such as another company in the same industry or a private equity firm. These partnerships often go beyond just providing capital. They can involve strategic alliances, joint ventures, or technology sharing agreements that can benefit both parties. Both private placements and strategic stock issuances can be attractive options for companies seeking capital without the complexities and costs of a public offering. However, they can also result in less favorable terms for the company compared to a public offering, as private investors typically demand a higher return for their investment. Section 9, the bottom line: it's all connected, so there you have it. We've covered a lot of ground, from IPOs to secondary offerings, buybacks to dividends, and everything in between. The key takeaway is this: the stock market is a complex ecosystem with many moving parts. Understanding where your money goes when you buy a stock is essential for making informed investment decisions. Remember, when you buy a stock on the secondary market, the money goes to the seller, not the company. However, the company can still benefit from a higher stock price, as it gives them more flexibility to raise capital in the future. Companies can raise additional funds after their IPO through various methods, each with its own advantages and disadvantages. By understanding the financial mechanics behind the stock market, you can make smarter choices about where to put your hard-earned capital and grow your wealth over the long term. So keep learning, stay curious, and never stop investing in yourself and your financial future.